Let's talk about the mid-cap sector. Mid-cap companies are companies whose market cap is above rupees 5,000 crore but less than 20,000 crore. Investing in these companies can be riskier than investing in large-cap market companies. This is because mid-cap tends to be more volatile. Since mutual funds are considered more of a safer tool of investment, should one with low-risk appetite consider investing in a mid-cap fund? Today on board, we will be discussing one such fund, and that is Sundaram Midcap Fund with its fund manager S. Bharath. Bharath S. Has over 20 years of experience in the industry across equity research and fund management. He currently manages 12,500 crore worth of asset across Sundaram Mutual Fund. But today, our complete focus is on, as I just mentioned, Sundaram Midcap Fund. Since mutual funds are considered more of a safer tool of investment, should one with the low risk appetite go for this fund? Welcome to the show, Bharath. It's nice to have you on board, and let's talk about the fund. We want to know more what's happening in the mid-cap space. So how are you looking at the mid-cap space right now in terms of valuation specifically? A lot of mid-caps have shown underperformance, but this fund in particular in last 1 year has given less than 5% return. Now, being a fund manager, what's your strategy to beat the volatility that you're witnessing right now?
Yeah, hi. Good evening, and thanks for having me online. So from the last year and a half, 2 years, we've broadly been seeing markets consolidate across large, mid, and small cap in specific. And in mid caps, you're right, we've seen a fair amount of volatility, especially pre the crisis of Ukraine and post the crisis as well. One of the fundamental constructs here is that the commodity prices, in fact, have been fairly volatile in the first 6 months of the year to where they are today. And this has seen a fair amount of a change in the way markets have been expecting earnings to behave, especially in the mid and small cap pack. So what turned out to be a quiet year actually started off with a highly inflationary note. And by the time the market started pricing in inflation, we are back to a phase where a lot of prices have started turning disinflationary for that matter. We've seen commodity prices, in fact, turn all the way back to 2018 levels in many a chain, barring energy. So this has seen a lot of change in the way expectations have been behaving in the mid and small cap earnings segment. And that's one reason why we've seen a fair amount of volatility come into the stock prices, especially in the last year and a half. So that's one. And the way we've been trying to deal with it in Sundaram Midcap Fund is that, so we've been broadly anchoring ourselves to 3 areas. So one of them is to have a fairly diversified portfolio across the various sectors and segments, and not really take skewed positions in the market at this point of time, given how dynamic the variables have been behaving in the last 2 years. And from that perspective, there's not been kind of trying to hit sixers or try to hit the ball out of the park, try to take the singles and score occasional fours the way we've been approaching this market. So sector diversification is one fulcrum on which the fund has been working on seriously over the last year and a half. And second has been in terms of choice of stocks. Again, we've been fairly aligning ourselves with companies which have leadership in the segments and having proven capabilities to use the opportunities which the current crisis has been throwing to them. So that's one reason where we've not been trying to move across in terms of bargain hunting, but rather consolidate ownership in names which have been showing track and position ourselves where there is a fair amount of scalability or runway for that business to grow over a 3-5 year period. So not losing the long-term picture amidst the crisis has been one thought process which has been kind of helping the fund. And three, in terms of the level to which we kind of take active bets in the portfolio, clearly it's been far more restrained in terms of how we kind of, how much ever we like or dislike a stock, we kind of not really take extreme bets in this market. We still believe we are in a fairly dynamic world in terms of most of the variables that we see around, be it interest rates or in terms of commodity price behavior or in terms of central bank actions. So these are some of the reasons which kind of prompt us to keep ourselves more measured in terms of our ability to take risk, as well as keep an eye in terms of what variables are moving around. So the third point is more in terms of risk management, how we are able to put across a framework which caps the extent to which we take deviant active bets in the portfolio. So from an investor perspective, what it clearly brings to the table is active fund management along with measured risk taking which I think is more apt for a market like this than what we are
But
probably
Bharat, what
exposed to.
about its ability to control losses in a falling market which is low? The fund
Yeah.
has doubled investors' money in 3 years' time, but Sundaram Midcap Fund Direct, if we talk about growth schemes' ability to deliver returns consistently in line with most funds of its category, its ability to control losses in the falling market is low. Now, what's the reason behind that?
Yeah, so a couple of things. So when we look at the way the fund is structured today, so if you look at the portfolio, we have around 65 to 67% mid caps, and a few of the mid caps are, in fact, they've turned large caps. So close to 15% of the portfolio is large caps today, which probably were mid caps a year back. And the extent to which the fund has been invested in smaller cap names today is probably in the mid single digits compared to probably around 18-20% 2 years back and close to 25-30% 3 years back. So there's been a conscious shift in terms of the cap curve of the fund, not by design, but more by outcome in terms of choice of business. So we've been moving in terms of choice of business towards slightly larger set of mid-cap names, which have been able to weather the volatility which the businesses have been facing all around. So that's one shift which probably, if you look at between a 3-year perspective to a 1-year perspective, it's been evidently showing up in the portfolio, the way it's been helping. And second, in terms of the earlier point which I mentioned, try to be with leaders in subsegments. That's one conscious call which we've been trying to build across in most of the sector and stock positions. If you look at it, we've been trying to build ourselves with leaders which have the ability to make use of a crisis in the best possible way. And that again is something which kind of limits the drawdown in a phase, even if, for example, we have seen, as in the last 6 months of this year, when commodity prices did sharpen, when inflation hit the roof, that was a time when some of these companies with pricing power were able to pass it on reasonably well compared to probably businesses which lacked the same ability to price themselves in such a condition. So size and scale does give benefit for these companies when it comes to tackling the worst of the conditions in terms of inflation. So which is where this shift in terms of aligning ourselves with businesses which have certain scale and pricing power does help to navigate these kind of markets. And that's something which limits the drawdown, if not avoid the drawdown, it at least limits the drawdown in a phase when we have unexpected changes happening around in terms of environment.
So let's talk about sectors now. The fund has majority of its money invested in financial, automobile, capital goods, healthcare, consumer discretionary sectors. It has taken less exposure in financial, automobile sectors compared to the other funds in the same category. Any specific reason behind this portfolio allocation?
No, actually, it's the other way around. In fact, in terms of banking and financials together, we have a fairly large ownership today in terms of our overweights compared to the broader benchmarks as well. And in fact, some of these bets within banking have been towards the reasonably larger banks as well as the larger mid-cap banks that we've seen. And in case of financial services, it's with the larger NBFCs. So one of the specific reasons for this has been clearly to avoid the phase of asset quality worries when we were dealing with the pandemic phase, which probably was one time where being with larger franchise which had the capital in place and the liability strength in phase in terms of cost of funds kind of helped them navigate even if there were to be any worries on the credit cost side. So that was one call which kind of was taken into the portfolio where we made a shift away from smaller size banks into the larger size banks and the larger mid-cap banks to be specific. And within NBFCs, again, the portfolio was moving itself and consolidating with the larger NBFCs, which in fact made use of the crisis to get themselves up into newer verticals during the last 2 years. So financials has been one anchor call in the portfolio to remain overweight. Of course, it probably would have played out only the last 3-4 months once the market started sensing the growth is coming back quite strong across both retail as well as MSME and the mid-sized corporates. But this has been a portfolio positioning in terms of overweight for quite some time. Industrials is more in sync with the house view that we believe that the investment cycle is coming back, albeit a little slower than what was expected. Government capex and household investment in reality has been shaping up nicely in the last 3 years. In fact, like-to-like basis, if you were to draw numbers, we've seen a fairly double-digit growth in terms of these two areas of the overall investment cycle. Private capex, we are seeing early signs of it. If we look at typical indicators in terms of EC clearances, the capex announcements by sectors like steel, cement, and all, we are seeing evidence of that coming around. But we'll have to see in terms of actual print in the years to come in terms of what is the quantum of jump that we'll see in terms of private capex. But definitely that's something where we've been kind of sticking a neck out that industrial should pick up once the investment cycle kicks in. Our positioning in industrials has been more towards the early cycle right now.
Yeah, so let's talk about the challenges now. In a few quarters, do you think mid-cap companies would be actually facing?
I think clearly one of the changes in the last 6 months has been the rate cycle. We've seen a 190 pips improvement, which is quite quick and fast compared to what we've been accustomed to in the past. And this will obviously have its way in terms of the demand and growth rates in a year to come from now, a couple of quarters from now. So that's something which one has to bear in mind in terms of moderating expectations, especially in the mid and small cap bucket, where if somebody has been seeing a fairly large growth in the last 3 years, that needs to be tempered given that the rate cycle has kind of moved back to pre-2019 levels in quite a big fashion. So that's one I would clearly warn out in terms of what it means to growth expectations and where one should anchor broad expectations. So that's one. And second, from the overall export set of companies which have linkages to global growth in the mid and small cap segments, and these are companies where growth is looking more uncertain than probably what it was a year back, I would say. We've seen developed markets, be it Europe or even partly some of the other markets, there are fair signs of growth tapering down or likely to taper down in the coming quarters. This should again lead to keeping expectations more rational for some of these export segments, which had a decent run, I would say, in terms of growth rates in the past few years. So that's, I would say, another area where one should be mindful in terms of pricing growth in the days to come. And third area, I would say, in terms of the commodity producers, as I think value migration from commodity producers to users is already on in terms of the broader trends. So extrapolating commodity profits, I think, is probably behind us in terms of what we've seen in the first half of the year. So as growth slows down, we should start seeing demand slow down. And to that extent, value migration moves from the producers to the users. So these are three areas.
So now few quarters which would be concerning, and obviously a lot will depend on the data that comes out and how the specific companies react as per that. Thank you so much, Bharath, for removing time and talking about your fund and all the nitty-gritties to our viewers and investors.